Okay, right. Now, welcome. Good afternoon, ladies and gentlemen. Thank you for attending this afternoon session. For those who are very new to trading or new to our sessions, our clinics, should I say, a warm welcome to you guys. Now, myself and Jonathan have been sort of doing these sessions now for a number of months since last year, and we try to keep it as interactive as possible. So you would have seen a chat box facility where you're more than welcome to ask any questions as we go along, and of course we'll endeavour to answer any questions as we move along. So today's session, of course, is using stochastics. So before we do move over to the main subject, just a very quick disclaimer here. Now, spread bets and CFDs are complex instruments and come with a risk of losing money rapidly due to leverage. So 75.2% of retail investor accounts lose money when trading spread bets and CFDs. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the higher risk of losing your money. So past performance of any strategy or trader should not be relied upon for future performance.
And Gerpal, sorry, just whilst we let people read through that quickly, I just saw a message from Judy saying that she's not getting any sound at the moment. So if people can hear us, if they can just give us another confirmation in the question box, that would be great. Just, oh yeah, people can hear us. I think it must be a problem with Judy's sound there. Thank you everyone for the confirmation, appreciate that. Perfect.
No problem. Right, so 2A Market, so we're a trading name of TMS Capital, and we've been established since 2003, and of course, most importantly, we are authorised and regulated by the FCA, the Financial Conduct Authority. Right, now that's the formalities out of the way. Jonathan, what we'll do is we'll take it away and we'll go through some of the theory behind this indicator of stochastics. So yeah.
That's correct. And well, just before I do, just before I get into the meat and bones of today's really webinar, I have a few different polls, and so I want to launch one of those now, as we do like to get an understanding of who's attending these sessions and how we can then assist those individuals. So bear with me. It's just always a nice question to ask at the beginning. So those of you who are attending today, how many of you are trading live? So if you've traded live before, if you're currently trading live at the moment, just say yes in that to that poll. As I say, it's always great just to get a gauge of who's traded. So, Gerp, I don't know if you see these results. People are just currently voting, but 91% of people are saying yes to this, 9% no. So that's very interesting. Although still it looks as if it's about 30% of people left to vote here. So still collecting responses.
Excellent.
Now, Gerpal, of course you know this, but we're here to help individuals. So whether you've traded before or whether you're completely new to trading, if you need any assistance, that's why we host these sessions. You can of course give us a call. I'll be sure just to provide our contact information at the very end of today's session as well. But the indicator that we're showing today is just one of several different indicators that we've shown during the course of these trading clinic webinars. And I know a lot of individuals, I hear it quite often, a lot of individuals are actually then applying these indicators to their own trading. So it's always nice to actually get that feedback. I don't know about you, Gerpal, but it's always nice to see that.
Yeah, I think it's always important to see, where people are in their trading journey, because let's face it, we do deal with a wide spectrum of individuals, some who've been trading for a number of years, some who are really literally at the start of their trading journey. So it's important to sort of cater for individuals and their sort of different requirements, I guess.
Absolutely, and with that said, it looks as if the final results of the poll has come through. So 81% of people have said yes. That means 19% of people have said no, they haven't traded live before. So as we go through today's session, of course, if I'm going too fast or if Gerpal's going too fast, do let us know. We're always happy to backtrack and clarify anything if there's any misunderstanding there. Now, a second poll just before I launch actually into the topic of today's session, which is stochastics. I think it's quite useful actually just to find out from those 20% of people, and we do have quite a few attendees here today, those 20% of individuals that haven't traded live, is there a particular reason why you haven't traded live? Is it the fact, for example, that you don't currently have a broker or a strategy? Or is it the nervousness about trading live, or perhaps actually funds? Is that a limitation for your trading at present? So this question really specifically applies to those 20% of individuals that haven't traded yet. Again, we really do like to get an understanding of who's attending these webinars, so that then we can actually cater these webinars around you guys. So.
I mean, I think a lot with a lot of different things, Jonathan. When it comes to trading, I think I'll probably say a lot of people are nervous about trading. Maybe with the strategy side of things, there may be two primary sort of stumbling blocks. I mean, absolutely, it can be very nerve-wracking when you're trading with real money, but a lot of these platforms now, you don't need a lot of money, and you don't need thousands in an account to trade. You can trade very small amounts, as we've sort of proven with the platforms that we introduced.
Now, Gerpel, funny you should say that. I know you mentioned that you would think that the majority of people are perhaps nervous about trading live. Well, looking at the results here, 10% have said no broker, about 45% no strategy, 64% nervous about trading live, and 17% funds. So in first place, it's nervous about trading live.
Yeah.
And actually, we have done specific webinars previously looking at risk management, things like that, haven't we, Gerpel, which perhaps would be particularly useful. So these sessions, they are recorded. Yeah, just give us a call if you find yourself in that position. And again, we have done previous webinars which may be specifically of interest to you, which we're happy to share as well. But I think everyone's perhaps itching at their seats now. So what I'm going to do is close these polls for the time being and actually get into the topic of today's session, which is stochastics. Now, stochastics is an indicator which can be applied to your charts on your broker platform. It is a free indicator, readily available on pretty much every mainstream, at least, broker. So it is a very popular indicator. It is what's known as a momentum indicator, hence the slides here. And I do say that similar to momentum in physics, momentum in trading is basically looking at whether it's going to continue on its current trajectory. So momentum indicators are used to determine the best time to buy or sell instruments. So they are very, very popular indicators as a result. Now, momentum in the financial markets is determined by factors such as the volume and the rate of price changes. But again, we've looked at an indicator called RSI before, and I'm going to actually touch on that a little bit later as well. But specifically today, I want to actually go through an indicator known as stochastics. So without further ado, stochastics was actually developed in the late 1950s by an individual called George Lane, and it basically presents the location of the closing price in relation to the high and the low range. Now that could be over a period of, say, 14 candles. That's the typical, the default settings. But again, it's looking at where the closing price of a candle is in relation to the range of the last 14 candles. Okay. So I've put here the indicator is sensitive to momentum rather than absolute price, and is actually an oscillator. We've looked at a few different oscillators previously, but an oscillator meaning that it gives you a value between 0 and 100. And so then it can be plotted quite easily onto a chart, and it can be read and understood quite clearly as well. And using the values that it kind of churns out, you can actually generate signals. So whether the market is overbought, so it's running out of steam, and therefore potentially due a reversal, it might start coming down, or whether the market's been heavily oversold, and perhaps, yes, again, running out of steam, and therefore could be due a reversal to see perhaps a bullish movement. Okay, but I will show actually, of course, what the indicator looks like, how you would be using it, the calculation as well for those who want to know. But rest assured, don't worry, you do not need to manually go through this process yourself. This is something which your broker platform will plot onto your chart for you. Okay, so stochastics, using stochastics, I've included a little image here. Granted, it is very small, but essentially this is how the oscillator will appear, and it will appear below that of your chart. You'll find two lines. Okay, typically there's a black line and a red line. It just so happens that this red line is a perforated red line. Doesn't make a difference, but again, you're going to find two lines on your chart. Okay. And going back to that individual who created it, George Lane, he indicates that the oscillator follows the momentum of price and not the price itself. And as a rule, the speed of the price changes before the price changes itself. So let's actually let that sink in for a second. So the speed of price changes before the price changes itself. And in this way, the stochastic oscillator can therefore be used to foreshadow reversals when the indicator reveals these bullish or these bearish kind of movements. Okay, but don't worry, again, this is just a picture of it. I will go through how you would essentially use it. But at this stage, just remember there's two lines, a black line and a red line, and it oscillates between the values of 0 and 100. Now, referring to that range, 0 and 100, if the value kind of given by the indicator is above 80, then we would consider this to be overbought. Essentially, it is looking at the momentum of the market. So anything above 80, the momentum is now wearing thin, and it could be due a reversal. Same for if the market goes below 20, that's a time at which you then may wish to actually buy the market. So if it's overbought, then it's running out of steam. You could be looking for a selling opportunity. If it's oversold, so below 20 on that oscillator, then that's where you may wish to therefore buy. Okay. Now, for those of you who have perhaps watched a couple of our previous webinars, we've spoken about RSI, which again, I'll touch on a little bit more later. That again is a momentum indicator, which is an oscillator. But with RSI, you would typically look at 70 and 30. But the distinction here is that with stochastics, we're looking at a range 0 to 100, but overbought is anything above 80, and anything below 20 is considered oversold. Okay, hopefully everyone's happy with things so far. Of course, we're going to be going through some actual examples on a chart. We're going to be looking at some current examples there as well. So, and happy to obviously go for any questions as they pop up here. Quickly, I'll answer Richard's question here. So in which time frame does this indicator work best? This indicator, it can be applied, of course, on any different time frame. In terms of what it works best on, this particular indicator, I quite often actually use it on hourly charts. I never tend to like to cram too many indicators on shorter time frames, so anything under 15 minutes. But certainly our daily charts as well, that's always quite nice. But what we'll do is we'll apply on a few different time frames later, and we'll also get Gerpel's opinion there. Now, I've brought us back to this slide here, and remember again how I was saying how the stochastics indicator, there are essentially two lines, that black line and that red line. Now, let me just draw your attention on to this, these lines here, where it says 80 and 20. Again, those were the ranges which I just mentioned on the previous slide, which determines whether a market is considered overbought or whether it's oversold. And so if those lines are above 80, so just where my mouse cursor is currently, in fact, let me see if I can get my annotation tools here. So bear with me. So in this area here, the market has gone, well, the stochastics value has gone above 80, so we would consider that to be overbought, and so therefore we would look to have a selling opportunity there. We then find this region down here where the stochastics indicator has fallen below that 20 value, which I mentioned. 20 is that oversold area, so we could be then looking for a buying opportunity. Once again, we find the market has then rallied back up. It's now considered overbought again. The momentum is dwindling, and so therefore it could be due a reversal, and so we would look to sell. So hopefully you can now see how those lines are used in conjunction with those 80 and 20 tram lines, which I typically refer them to. Okay. Perfect. Now, if I was just to get rid of my annotation and go back to the slide here, I just want to go back to those two lines, just so you know actually what they are and what they do and what they mean. So again, you typically would find that one of them is black, the other is red. That's just traditionally how it's displayed. You can change the color of these lines on your broker. But for the purpose of this example, the black line is also known as the K line. It is the raw measure used to formulate the idea of momentum behind the oscillator. So think of the black line as the key line, whereas the D line, which is typically shown as red, that's simply a moving average of that K line. So it's going to therefore lag behind slightly. Okay, so you have the key formula of the actual indicator itself, and then you have a moving average of those values, so it typically lags behind. That's why you have the two different lines on the chart. Now, I always get a handful of people asking me for the calculations, so I'm going to just show that very quickly before actually then going through how you would use the indicator. So for those who wish to, here's a little slide here. This is how the K line is actually calculated. Remember, I don't want this to be some daunting practice here. You do not need to work this out manually. It's really for those who wish to understand it a bit better. Essentially, looking at this formula, though, you're looking at the highest high for the period and the lowest low for the period. You're subtracting them from each other to find the actual range of the period, and you're looking at where the closing price actually lies in relation to that range. So again, that's the whole purpose of this indicator, to find out where the closing price is in relation to the actual range of a market. And then, of course, you have that D line. Typically, of course, we know that to be red. In this instance, it's a red perforated line, that being the actual moving average. So again, don't worry, you don't need to actually calculate this manually, but just remember that it's simply giving you an indication of where the closing price is in relation to the actual range. Think of it like this. Let's say there's been a very bullish move in the market. The market has just jumped up over the last couple of days. Now, if there's momentum in that move, then what you would tend to find is that the closing price would be towards the higher end of that range. So if, of course, the closing price was near the low, then of course it's lacking that momentum. It's almost going the other way there. Okay. So I'm going to move on from this slide. I don't want to scare anyone off. If of course you would like the actual calculation, I can share that with you after today's session. But the reason, of course, why you're all here, how to actually use the indicator. Well, George Lane, that individual that created it, he really identified two ways in which you can use it. And Gerpel and I, we're going to be going through some actual live charts in just a second. We're going to head on over to a broker platform and actually go through some examples. But the two ways that you can use this is, as I've mentioned previously, where you have those overbought and oversold areas. So if the market is overbought, then we may wish to then place a sell trade. If it's oversold, we may wish then to place a buy trade. The second method in which we can actually use this indicator, which we'll be going on to in just a bit, is divergence. Okay. Now, just before I actually go through that any further, I'm just seeing here there's a few questions. So Morris has asked, will there be a recording of this available? Yes, this session is being recorded today. What we tend to do is then put that onto our website. So in the top left-hand corner, you'll find www.twowaymarkets.com. If you go to our website, there's a webinars section, and you can find a few of our different sessions there. This should be added there later this week. Perfect. Nicholas has asked, how is this different to the MACD then, please? It might be actually best if we were just to cover that once we're on to the actual broker platform, so then I can show you visually. So perhaps if we just continue this bit first. If you could ask that again a little bit later, Nicholas, just to remind me in case I forget. Okay. Glenn has asked, can it be used with or instead of RSI? Now that, interestingly, is a point that I want to get onto in just a minute here. I've actually created a slide for that. So what I'm going to do is cover these two methods of how you would actually use the indicator first. And so, first of all, first method, I mentioned about those different ranges. Now, if we were to look here, we've got a chart at the top, and then the actual stochastics indicator at the bottom. And if I was just to get my handy little annotation tool out again, you'll notice that we have those tram lines, the 80 and the 20. So anywhere where the market is below that 20 line, we consider that oversold. And so when it was to then break up above that 20 once more, that's typically the point at which we would look to buy, which has been annotated here on this chart, this little green arrow. As for when it goes above 80, that's when it's considered overbought. The momentum's now dwindling, could be due a reversal. And so when the market was to drop back down below the 80, i.e. this point here, that is where we've seen a sell signal. And sure enough, the market has gone down just like it had gone up before. So it's quite nice actually there. With regards to this section here, yep, we've entered this area where the market is considered oversold. But again, it's typically actually the point where it then crosses above that 20 line again, where it would look to actually place that buy trade. So hopefully you can start to see very easily those 80 and 20 levels and where our entry points would be. So again, the market's dropped below 20. It's then coming back above that 20 line at this point here, which is where we would place a buy trade and so on. So that's actually a really nice example of how the market moves there. And that again is the first method, just simply identifying overbought and oversold areas, very much like how an individual would tend to use the RSI indicator. Now, perhaps the alternative method, one which I know certainly Gerpel quite likes, is the divergence. So let me remove my annotations here. And if we head on to the next slide. So the key thing about this is that if the market is trading in the opposite direction to the indicator, then a reversal may be due. So what you'll find here, if I get my annotation tool out again, the actual market itself has been going up. However, of course, the stochastics indicator is saying that the momentum is falling. There's a divergence. They're going in two different ways. So if the market is making new highs, but the momentum in the market isn't following, we would typically then look for a sell. But there's literally just no steam left in the market. And if the market is making new lows, so which is in this instance here, so if the market is making new lows, but momentum is seen to be increasing, which is what we have here. If we look on the actual stochastics section of the chart, we would look to buy. So again, there's a divergence. Now, as within any indicator, you can always get false signals, but you can reduce that by actually combining different indicators together. But again, this is the second method, perhaps a little bit more complicated and more difficult to actually identify, but you're just looking for these areas where the two are showing two different pictures. So this is printing new highs. However, the actual stochastics, the momentum is actually dwindling. And so that's where we would be due for a reversal. Whereas with this instance, of course, we're printing new lows, but the actual momentum, the actual closing price in relation to the recent range has been steadily increasing. The momentum is kind of is foreshadowing this reversal in the market move, which makes the actual indicator very, very popular and very useful for that fact. It's foreshadowing movement. Now, I know a lot of indicators can be lagging. This is why I quite like the stochastics indicator for that foreshadowing ability there. Now, before I pass back to Gerpel here, I mentioned about stochastics and RSI. They're both very, very similar if we were to actually look at them. Now, I know, look at them together, I should say. I know that a lot of the individuals here today have seen our previous webinars on RSI. There's going to be a few people that, of course, don't know what RSI is, but just so you know that RSI, stochastics, they're both momentum indicators. They both are oscillators, so they oscillate between the values of 0 and 100. They both, therefore, help you identify overbought and oversold conditions. However, they do them in noticeably different ways. So whereas the RSI measures recent gains against recent losses, as we've discussed today, the stochastics is specifically looking at where the closing price is in relation to that range. And so generally speaking, and this is the big kind of distinction between RSI versus stochastics, what you should use, generally speaking, the RSI is more useful in trending markets, and the stochastics are more useful in sideways or choppy markets. So those conditions which perhaps you're finding difficult, that's when stochastics actually is typically more useful. And in fact, stochastics, it does react a lot quicker to market moves as well. And so if you were to compare RSI and stochastics, you'll likely find that the stochastics would actually make its move before that of the RSI. Generally speaking, if you were to keep the same 14 period parameters, which is the defaults for those. But I know everyone's obviously going to be quite keen to actually see these on the charts here now. So, Gerpel, I don't know if you're still there, but I've loaded up the ETX chart. Let me change that back. Yeah, there you are. Sorry, go Paul.
Sure. Cheers. Right now, I know looking at the stochastics it seems actually fairly straightforward, and it is actually, Jonathan, and pretty much what you said earlier. You can use it one of two ways. So you've obviously, as Jonathan mentioned earlier, you've got the overbought and oversold levels here. Now, I mean, just giving you a very simple example here, you've got the stochastic indicator at the bottom, and this is the ETX platform. So just here, you can quite simply search for it and add this to your sort of indicator list here. But if you have a look here, this is just a FTSE 100 UK, and this is just a daily chart. And you can see here, there's a AT line at the top. We've got the K line crossing below the D1 here, Jonathan. So as soon as we got that crossover, you've had a very good sell signal here. So there we go. I mean, what I find here is it works really, really well, more so when the crossover is either above the 80 or below the 20. Now, of course, you can use it when it's in between, but that could sometimes cause sort of false signals, as we've seen a few times here. And we've got a let me, if I can bring out the lines here. You've got an opportunity here. So there's a crossover. There's a crossover here on the FTSE. And of course, if you sold here, you would have had what, 6,200. Yeah, 5,880. So yeah, there's almost 300 points move, and this is a daily chart, remember. So obviously, the one thing I would like to sort of say is you can use this both directions. So likewise, you've got a fantastic opportunity here where we've got the 20 perimeter, where we've got on the FTSE daily, we've got a crossover here. And then, of course, if we've bought there, we can see the price then. It's been a fantastic buying opportunity. I mean, that was almost, even if we buy it from the top of that candle of 5,600, we've seen the market rise all the way far beyond 6,700 since. So, you know, ultimately, it is a simple method of using. And just to show you the divergent side of things here, look at the FTSE daily here. Interesting, you've got making higher highs on the FTSE. You can see here on the price action. But if you look at the divergence of the stochastics here, you can see, in actual fact, the stochastics now is making lower lows. So
it's actually unlucky there, Gurple.
I was going to say, I've done so many indicators in the last few years.
All blurred into one there, Gurple.
Whether I'm coming or going, to be honest with you. But you can see here, look, you've got the FTSE, which has been moving upwards, and you've got the stochastics, which has shown a divergence, a bearish divergence. So essentially, what could that could potentially mean is this the upward momentum on this FTSE chart? The FTSE has been going up since November. It's been going up, but you know, all of a sudden the divergence is now showing very much a bearish tone. So there we go. So, you know, it's giving you a bit of a leading indicator, showing you that actually not all might be as well in the FTSE as it first may looked in the charts here, Jonathan. So if we go here on the Dow again, or just add in the stochastics there again, and pretty much the same thing here. I mean, if you look at the Dow here, this is just a daily chart. We've had fantastic crossovers here, Jonathan. Look at this. This is, again, a daily chart. And if I just move this across here, again, look, these are extreme sort of areas just below 20. Look, you've got an opportunity to sell, to buy there, should I say. And there's the price action there. So you would have been buying at 27,150. Yeah, you could have bought that. Well, you can see how many points. And again, on the top end of it, where it's the top end on the 80, you could, of course, go and look to sell there. And then look, you've got a fantastic drop here. And likewise, look, I mean, these trades, they're not everyday trades, but this is on a daily chart, remember. And when they do come, they're certainly worthwhile having attempting. Look, we've got a crossover here. The stochastics have moved over and the market's rolled over. It's just been going up. Now, if you've seen the Dow Jones in the last few weeks and months, it's just been going sideways. It's consolidating. So really, there is no real move there. So what I'm trying to say to you here is the daily aspect of it will always be more accurate when it comes to using stochastics. Of course, you could drop this down to a 15-minute or a daily, but you're going to be susceptible to more sort of more false signals, if you like. It's always going to potentially give you more false signals. So for me, I definitely prefer the end of the sort of a more end of day approach to stochastics. That's my opinion here. And here's another example of divergence. This time, in fact, it's bullish divergence. So you can see the gold made an all-time high last year up to sort of $20, and it's been coming down ever since, and we've had this move down. But you can see the divergence has all of a sudden started to pick up. It's getting bullish. So could this be a sort of an area where the gold price is now basing for it to go back up again? So again, that's what we call bullish divergence. So the opposite of what we've been seeing. And again, you can use this as a crossover here. So you could see here the gold where the market's been moving down. There's a crossover there, but potentially I would look at the significance of the divergence here more so. So it's got a few charts here which we can show you here. Again, this is a very nice example of bearish divergence. You have the euro sterling. We've been increasing. We've had some good higher highs on the price envelope here, on the price pattern on the euro sterling. But look, the divergence on these now, look, it's been coming down. Let's move that. The divergence on the stochastics, we've been making lower lows, which means that this upward channel potentially is running out of gas. And lo and behold, look, the price has just been going down ever since. Look. So it's giving you a bit of an idea of potentially when the actual trend may be coming to an end. So that's a nice way of looking at this. And we'll move over to the euro sterling here again. Now this one again is maybe a bullish momentum shift. So we've seen the euro Swiss, Japanese yen. This is a 4-hour chart. We've been coming down since January, start of January. So we're coming all the way down, making lower lows. Now you can see the divergence here. The actual stochastics is now printing higher highs. So potentially, could this be a reversal back upwards? Yeah, so really, the next time this comes down and it crosses back over, it could be a buying opportunity on the euro yen. And again, the same on the euro dollar. Euro dollar again showing you negative divergence. So you got the euro dollar going upwards. You can see that since October it's been going up. You can see the divergence here. It's been actually making lower lows all the way, and that potentially could mean we could be cracking back down again. So this upward move we've been seeing since sort of November could be coming to an end. So potentially, when this market is another sort of a case of if it does roll over again, you could look to sell this. Yeah, I like to use this, Jonathan. I'm not going to lie, more so with divergence than the crossover. That's my personal.
I remember you saying that before, yeah.
Yeah, with RSI, you tend to look at the crossover. Yeah, I think someone asked a question earlier. For me, I think stochastics is more powerful with divergence than with. You can use it with crossover. I mean, let me just show you this little. This is one little strategy like that variation. A slight variation. I've got a 200-day moving average. Now, for those of you who know, so if you know, you know. If you don't, you don't, definitely. But the 200 moving average is the line in the sand between the bears and the bulls. So what I do is, every time the price is above the 200 moving average, I only look for buys. I don't look for crossovers down. So, for example, here, Jonathan, so I can see the price is above the 200 moving average. Let me get the drawing here again. Look there, let's show you that. 200 moving average, there's the price above. We've crossed over there, buying opportunity there. I buy there, Yeah, making nice pips there. So it's come back down again. Look, there, price is still above the 200 moving average. Another buying opportunity there. There's the crossover there. Yeah, you'd make a few pips there. And again, same here. Look, potentially, you know, there. And
So
here, potentially, so go on.
If I just like rationalize this in my head quickly, so of course now you're not using the 80 and the 20. However, where we have that line in the sand, essentially what you're doing is you're taking those crossovers when there is actually when it's going with the trend, because if of course the price is above that of the 200, then generally speaking that means that the long-term trend is going up, and you're specifically taking those momentum shifts, those positive momentum shifts, which are going in the direction of the long-term trends. I can see, actually, I can rationalize that in my head. I can see how that works.
Yeah, the whole point is, if you have a look at this, look, the price is going up, it's above. I mean, the price has been going up. It's always safer to trade with the trend than against the trend, Jonathan. It's simple. Yeah, EMA, Ian, EMA is the moving average that I'm using here. But it's always safer using with the trend rather than against the trend. It always has been and it always will be. Let's just see if I can pick something here from let's just pick another market here. German DAX, let's just say. Oops.
I think you were just looking at the DAX, but it was on was it on a daily chart before?
It may have been, yeah. Let me just see if I can. Let's just get rid of these moving averages here. So someone's just asked me, how do I add all that on? So look, let's just move over to, I don't know, let's say hourly chart. Stochastics, I've already put in there. So there's the stochastics here, the German chart. This is a daily chart. If I move that, let's just see if there's anything on an hourly. So more of an intraday type of situation here.
Actually, sorry, you can just whilst you're doing that, it might also just be worth sharing just afterwards how to apply it from fresh rather than as a chart template, actually going into the indicators list, but perhaps just worth sharing that afterwards.
Okay, well, there you go. Look, I'll show you here now. Look. So if I pop in stochastics there, you can see the stochastics indicator there. That allows you to change. Now, the one thing I want to add here, Jonathan, with the settings, with a lot of indicators, we say generally just leave them alone, leave the default. For stochastics, I think it's worthwhile tinkering with these. I mean, I know people that use, for example, 8, 3, and 5. Some use 10, 6, and 6. But this all depends generally on your style of trading. Some people like trading off a 5-minute, 10-minute, 15-minute chart. Some people prefer, 4-hour daily chart. So, you've got to tinker with the periods here just to get fine-tune what you're looking at here. So I've just left the standard one here, but I mean, that's here. Let me, if I just add in the moving average here, if I add in a 200. That's okay. There we go. It's just a bit slow. Okay, so there's the 200 moving average. So you can see here now we're below the 200 moving average. So next time this curls back up and it goes back down, will be a selling opportunity for me. Does that make sense, Jonathan? Hopefully it does.
Oh yeah, absolutely. Yeah, so
that's all
below there.
Look. Yeah, look at this. Look at this. If I can bring this, and this is an hourly chart. Remember, look. So there, I'd have bought it there. You would have sold it back up there. So you'd have been making money there. So anytime it's above the 200 moving average, like it is there, look, we've got a crossover there. You buy, look, and bang, it's gone back up because you're going with the trend rather than against.
You're entering on the stochastics more aggressively, but at the same time, you're making that decision based on the fact that you know that it's it's at that point in time going with the trend. So I
it's
can see
more of an
that.
aggressive way of approaching. You can see that the market's cracked down with 200 points down this afternoon on the German DAX. Now, of course, this will curl back up, but it's probably, in my opinion, it will probably curl back down again. So that's when it does curl, when it crosses back down, is a lovely chance for you to actually go in and sell it again. Because look, you're below the 200, you're going with momentum, and you're actually looking at this. And another way of maybe looking at it is if you do a horizontal line in the middle, in the 50 or as close to the 50 there. So there's the middle section. So potentially, if it comes back and curls back down, there's another selling point there. You could come back down again. So these are just trigger points that you can enter the market at.
Yeah, so with the indicator, as with any indicator, as you become more familiar with it, you can then use it in different ways, and you can apply it to, use it in addition to other indicators too. If you were just wanting to keep it at its basics, though, of course you can do, and it's the best way to learn the indicator, and that's when you may wish to explore these alternative avenues. But I would argue, Gerpel, that it is certainly one of the easier indicators to actually understand and to initially spot. If you were to keep things basic with the 80 and the 20 levels, if it's overbought or oversold, then it's quite nice to identify.
It's giving you opportunities everywhere here. Look, it's giving you opportunities here. Look, we've got a crossover there this morning. The price is above the 200, so there. Look, you've got an entry point there. Entry point of 13,870. 14. There you go. It's up to 14,000 there on the DAX. So it's giving you good tips.
What I like about
an hourly chart.
What I like about that, those two examples which you've just noted there, Gerpel, is that you almost have that additional confirmation from the 200 because it's actually bouncing from that 200 line, which that 200 line, as we said, is that line in the sand. It gives you an idea of the long-term trend, but it's a big area of potential support. The fact that the stochastics has been a crossover and also it's bouncing from that big area of support, it's almost that kind of additional confirmation, which is what some people are looking for.
Ultimately, listen, Jonathan, I'm not interested. As long as the price is above the 200, I'm not interested in the drop down. I'm only interested in buying. Once the price comes below, then I might want to look at the sells here. That's the whole point here. It's the important part of it is looking at the crossovers here. So, for example, here, the price has come below here. And let me show you one that's opposite just before we finish off today. Look. So we've got a crossover here. Oops, there. It crosses back down. And if you had sold there, the price is below the 200. Look, we would have sold that and would have sold it all the way down to there because the price is below the 200. So, it's a very simple way of trading. It's more for day trading. Don't get me wrong. I use it now and again. I like to use it when the market's a bit more volatile. But again, like I said to you before, for me, the most powerful method is looking at divergence. That's where it really comes into its own. Divergence is nice. Look at the FTSE here. The divergence is important on the daily chart. The technicals of the market.
For those individuals perhaps left scratching their head thinking, how is this different from RSI? Yes, visually it looks very similar, but as Gerpel just mentioned, you have the divergence method of the indicator, which is very powerful. It is also an indicator which moves typically quicker than that of the RSI. You also have to bear in mind that the stochastics, because of its calculation, it is better in these more testing market conditions, whereas RSI works best in those trending markets. But trending markets are easier to trade on anyway. So,
Jonathan, I've just picked out three trades here for you. Look, and it's the same principle that I did on that 15-minute chart. This is on a daily chart. Look, every time the price is below the 200. Are we in agreement there? Yeah, we're below the 200. Look, the stochastics has crossed down. Look, you sold there, you would have made money. The stochastics has now crossed again. You sold there, you would have made money. Stochastics again, crossed down. You sold there, you would have made money. Same again, it's come down. And likewise here, because the market's down. Now, it's only here where the market has now gone above the 200 recently. So this is why I think it works well. So that's, I would say, I'll leave you with those sort of couple of strategies to have a little play around with. And
I think just a quick question, as I know we're coming towards the end here. So Malcolm's asked, so what is the best for starters for 14.3.5? Malcolm's referring to the settings there. Certainly those are the default settings. That's what you're going to find across pretty much all broker platforms when you apply. Once you're familiar with it, that's when perhaps you may wish to experiment, but it's always best just to start with the default.
I mean, Jonathan, if I just interrupt you for there 1 second, what I'd say to you, Malcolm, is if you find that you're getting into the trade too late or you're getting into the trade too early, tinker around with those numbers. That's what they're there for. If you're on a 4-hour chart, an hourly or a daily using this type of strategy, and you find, I'm always getting in a bit slightly too late or too early, have a little play around with it, change those numbers around, you'll find a medium, because a lot of it does depend on the type of market you're trading. We all know the FTSE is very different, the way it trades, to the Dow Jones. They're both indices, but the Dow Jones is ultra aggressive in the way it moves. The FTSE is a lot less, it's more conservative. So it means those settings might be slightly different. And the same with currencies. You get the euro sterling, which is very conservative, but then you probably get the sterling dollar or the euro dollar, which certainly can have a lot bigger moves. So, one setting is not always going to suit every market, because let's face it, all these markets are different. They move differently. Their tolerances and their volatility are different. So, you do need to go in and have a look at what works best. But you've got the fundamentals of a strategy here, which potentially it works quite nicely, and hopefully you can take on board with yourself.
And Gurpal, I like to go full circle here, but I know at the very beginning we actually had that poll where it was specific to those 20% of individuals who aren't yet currently trading, and some individuals, of course, said that they were nervous about trading live. Some said they didn't have a strategy. I believe that was the second most popular answer there. Now, hopefully, these sessions, these trading clinics, we can help you, just show you a few different tools which can be applied to the chart, and hopefully we're all learning something as a result. But talking of polls, there is just one final poll which I was looking to launch as we're now approaching the end of the session. So this one I always find as a bit of an interesting question, Gurpal. So, I accidentally closed that. Unfortunately, I just opened it and instantly closed it, and now I can't relaunch it. I was going to ask, what area of your trading do you feel could be improved the most? But now I can't even see the answer there. Sorry. Now, bear with me then. I guess in that case, what I'm going to ask, and this actually ties into what Gurpal was just saying about the different instruments that an individual can trade on. The Dow behaves very differently from kind of a currency pair. So it's always interesting to gauge which instruments you're specifically interested in, because then perhaps we can show indicators which perhaps work better for those different markets, or we can show the actual changing of those settings, those default settings, so that then it perhaps would work best on some other markets. So yeah, that poll is just currently ongoing, Gurpal. So just so you know, in case you can't see the answers here, what we're finding is, and this is multiple choice, but 70% of people are saying indices. That's what they're most interested in. 68% saying FX. 35%. This is actually a lot larger than I thought. Actually, are saying stocks, Gurpal. 25% commodities, and actually this is a talking point in and on itself. But 6% of individuals are saying crypto, and that is an interesting one because, of course, the rule changes that have been there and how that can't actually be traded as a derivative anymore, at least not in an FCA-regulated environment.
But the one thing I would say to you,
very, very interesting.
is it works really well with stocks, actually. The stochastic side of things, if you ever look at a weekly or a daily stock chart, it works really nice. You can use divergence. What I showed you earlier with divergence, bullish divergence, and negative divergence. It's a wonderful tool to use with stocks, especially if you're investing. You are moving to long-term investments. Cryptos is my thoughts on cryptos anyway. The less said, the better. But for those of you who want to trade stocks, give it a try on the long-term time frames on some of those stocks. It's quite nice, actually. It's quite a nice way of looking at some things there. But so that's our details here, Jonathan.
Brilliant. Well, yes, thank you everyone for attending. Hope you enjoyed today's session. If you have any suggestions for what we should cover in future sessions, please do just drop us a message or just drop us an email. Always keen to go through topics which are suggested by the audience. So thank you everyone, and hopefully we'll speak soon.
Good afternoon, guys. Thank you very much. Bye.
Bye for now. Bye.